Have you ever looked at a candlestick chart and wondered what it really meant? Not just the green and red bars, but the hidden story behind each move, where institutions enter, where traders get trapped, and where real opportunities lie. If you're aiming to pass a prop firm challenge or trade like a pro, understanding volume candlestick analysis is non-negotiable. Welcome to Prop Firm Ask. Here's the thing, most traders fail not because they don't work hard, but because they're reading the market wrong. They focus only on price, not the force behind the price. Volume. Volume tells you why something is happening. And when you combine volume with price action, you unlock what the smart money sees. In this masterclass, we'll break down everything. What candlesticks really represent, beyond the basics. How volume confirms or denies price movement. The 6 psychological volume principles pros use. Real-world case studies using daily 15-minute and 5-minute charts. And how to build a prop firm-ready strategy around volume and candles. You'll learn how to read the tape like a funded trader, spot traps, identify real breakouts, and time your entries with sniper-like precision. And no, you don't need fancy indicators. Just clean charts, volume bars, and a trained eye, which you're about to develop. So if you're serious about becoming a consistently profitable trader, stay with me till the end. This isn't fluff. This is the exact volume candlestick blueprint used by professional traders and successful prop firm applicants. Let's jump into Chapter 1. Chapter 1. What are candlesticks? To trade like a prop firm trader, you must stop seeing candlesticks as simple red and green blocks and start seeing them as snapshots of a battle between buyers and sellers. Every candlestick tells a story: who's gaining control, where traders are trapped, and where money is likely to flow next. Let's decode this properly, the way professional traders interpret them. Each candle reveals 4 essential price points: the open, high, low, and close. But behind these numbers lies the emotional narrative of the market. Open. This is the initial battlefield. It shows where traders first agree on value after reviewing all overnight developments. It reflects early sentiment, and institutions often set positions here. High. This marks the furthest bulls push the price before running into selling pressure. If a candle closes far below the high, sellers rejected that price level. Low. The lowest point reached during the session, showing how far sellers pushed the price before buyers stepped in. Long lower wicks signal demand zones or absorption. Close. This is the most important price. It tells you who won, bulls or bears. In strong trends, the close is usually aligned with the trend's direction, but that's just the foundation. The body of the candle, the range between open and close, reflects conviction. A long body equals strong sentiment. A small body equals indecision. The wicks show what price was attempted, but ultimately rejected. Here's what most traders miss. Context is everything. A bullish candle in a downtrend could be a reversal. A bearish candle at resistance might signal distribution. A doji in consolidation? That's indecision, not a trade signal. You should never analyze a candle in isolation. Prop traders always ask, what phase is the market in? Is it trending? Accumulating? Breaking out? The same candle means something different in each phase. Now let's talk about volume. The other half of the story. Imagine you see a big bullish candle. That looks like strength. But if the volume is low, it might be a trap. High volume? That could be real buying. Volume validates price action. And that's what separates pro traders from amateurs. Here's a scenario. On the 15-minute chart, EUR/USD prints a massive bullish candle after news. But the volume is lower than the previous 3 candles. What does this mean? It's likely a false move. a liquidity grab or trap. Smart traders sit out or fade it. Retail traders jump in and get crushed. This is a key concept prop firm traders master. Price tells the story, volume confirms it. Now let's address why candlesticks form the way they do. Institutions, or smart money, never enter the market all at once. They accumulate positions. That's why before major moves, you often see a series of small candles, tight ranges, and long wicks. This isn't noise, it's the smart money preparing. So don't just ask, what does this candle mean? Ask, why is it forming here? What came before it? When you begin to read candles in groups, the story becomes clearer. A single candle is a word. A group is a sentence. A pattern is a paragraph. This is exactly how elite traders view charts. They don't memorize candlestick names. They read momentum, absorption, and intent. Let's look at some popular candle patterns and reinterpret them using smart money logic. Pin bars, a long wick with a small body. It's not just a reversal, it's price rejection and imbalance. If volume confirms, it often marks a strong turning point. Engulfing patterns, a candle that completely swallows the previous one. That's dominance, a shift in control. Context matters. At resistance, strong signal. Inside bars, a small candle trapped inside the range of the previous one. Think of this as a coil, a pause before expansion. Institutions love these areas to build positions. Wide range candles, large body, possibly with small wicks. This shows strength, but only if volume backs it up. Now here's a pro-level insight. A candle's size doesn't always equal its strength. A massive bullish candle on low volume, weak. A small bullish candle on high volume, that might be smart money absorbing supply. So always check volume. It tells you if the move is real or if someone's being baited. Let's quickly recap. Candlesticks are emotional footprints of market participants. Open, high, low, and close each tell part of the story. Bodies show conviction. Wicks reveal rejection. Context is critical. No candle is meaningful in isolation. Volume either validates or contradicts price action. Patterns mean nothing unless volume and context align. This chapter alone can help you avoid hundreds of bad trades. But when you combine this candlestick foundation with advanced volume analysis, that's when you enter elite territory. Coming up in Chapter 2, we'll break down how to read volume bars with the eyes of a prop firm evaluator, how to decode market intent through volume spikes, and how to tell when a breakout is real or just bait. Let's keep building. Chapter 2, Volume Analysis Basics. Ever noticed how sometimes price barely moves, yet there's a flood of volume underneath the chart? That's not noise. That's the market whispering secrets. Volume isn't just a number. It's a footprint left behind by smart money. And if you know how to read it, you unlock the unseen layer of the market, where true intention hides. In the world of prop firm trading, volume is one of the most underused tools, and also one of the most powerful. Price tells you what happened. Volume tells you why. Together, they tell you what's coming next. And this section is all about making you fluent in the language of volume. Let's break it down. Clean, deep, and prop firm sharp. What is volume in trading? Volume represents the total number of shares, contracts, or units traded during a specific time period. Whether you're trading Forex, crypto, or equities, volume is a mirror of activity and urgency in the market. Think of it this way. If price is the conversation, volume is how loud that conversation is. A whisper or a shout can change the meaning of the same words. Likewise, a price move without volume is often weak or fake. A price move with volume, that's conviction. Types of volume you need to know. High volume up. This signals aggressive buyers. Prices are rising and participants are eager to enter at higher prices. It usually confirms an uptrend or an upward continuation. High volume down. Now the opposite, aggressive sellers. This could mean a strong sell-off, profit-taking, or a trend reversal if it comes after a long rally. Low volume. This is quiet market activity, often seen during consolidations, holidays, or indecision zones. In prop firm terms, this is the chop you want to avoid. The time when doing nothing is your edge. Climax volume. Often a peak in volume at the end of a trend. It's where institutions exit and retailers buy the top or sell the bottom. These are crucial spots for reversals. Volume divergence. Price makes new highs, but volume doesn't increase? That's a warning. This divergence tells us that fewer participants support the move, and a reversal or pullback is likely. Why volume is essential for prop firm traders. Prop firms demand precision. It's not about how often you trade. It's about how accurate you are when you do. And volume gives you confirmation. It tells you when your trade idea has backing from real market participants. You're not trying to beat the market. You're trying to ride with the professionals who move the market. Volume is their fingerprint. How to use volume practically. Let's simplify this into 3 major applications. First, trend confirmation. If price is breaking out, say above a resistance, but volume is low, be skeptical. That breakout may fail. On the flip side, if the breakout comes with high volume, odds are it's legit. That's your go signal. Prop tip: volume confirms breakout direction, especially at key levels like supply-demand zones, VWAP, or order blocks. Second, reversal detection. Volume spikes during major highs or lows often suggest smart money offloading. Combine this with reversal candlestick patterns, like a pin bar or engulfing, and you've got a high probability setup. Prop tip: reversal signals are often volume plus pattern plus location on the chart. One without the other? No trade. Third, trap recognition. Ever been faked out by a candle that breaks support or resistance and reverses? That's often a liquidity grab. Volume can expose these traps. If volume is low on a break, it's probably fake. If volume spikes but price doesn't follow through, institutions might be absorbing the move. Smart traders wait for confirmation from both price action and volume behavior before committing. Volume and time frame dynamics. Volume behaves differently across time frames. Here's how to adjust. Lower time frames, 1 minute to 5 minutes. More noise, quick volume shifts. Useful for scalping setups, but dangerous if misread. Mid time frames, 15 minutes to 1 hour. Better context for intraday prop firm trading. Higher time frames, 4 hours to daily. Institutional intentions are more obvious. Strong for swing setups or daily structure bias. Prop tip: if the volume on your entry candle is confusing, zoom out. Always check the next higher time frame. Market structure plus volume confirmation equals sniper entries. Tools to track volume effectively. Most trading platforms offer basic volume histograms. That's fine for a start. But for prop level edge, consider these tools. Volume profile shows where the most trading occurred at specific price levels. Value area, high-low, POC. VWAP, volume weighted average price. Institutions love this. It's the average price based on both volume and price. OBV, on balance volume, tracks volume flow relative to price, helps anticipate trend shifts. Delta volume, in futures, measures buy versus sell volume imbalance, direct smart money detection. Final thoughts on volume basics. Volume is not just a secondary tool. It's your truth detector in the market. It exposes fakeouts, confirms breakouts, and gives you confidence that your setup is backed by real momentum, not just empty candles. Trading without volume is like flying blind. Prop firms don't fund guessers, they fund interpreters of market intent, and volume is your translator. Chapter 3: Volume Candle Principles. What if I told you that every candle on your chart contains a secret message, but only if you look at it the right way? Most traders stare at candles, hoping to guess the next move. But funded traders read candles like a diary entry from smart money. And the key to unlocking this is combining candlesticks with volume, precisely and deliberately. In this chapter, we're diving into 6 core principles that govern how volume interacts with candlesticks, insights that professional prop traders use to detect hidden pressure, trap traders, and shifts in market control. These aren't just abstract theories. Each principle translates directly into an edge you can deploy live. Let's start cracking the code. Principle number 1: wick length reveals strength and intent. The length of the wick, whether upper or lower, instantly signals the strength, weakness, or indecision in the market. A long upper wick shows aggressive buying got rejected. Sellers hit back hard. A long lower wick means buyers stepped in to defend price after a deep push down. No wick at all? That's a strong, uninterrupted move. Real conviction. Volume insight. A long wick with high volume often means a rejection by smart money, while the same wick with low volume might just be noise. Principle number 2: no wick equals strong conviction in one direction. When a candle closes without a wick on one side, for example, a full-bodied bullish candle that closes on its high, this suggests no resistance or hesitation. The market moved decisively and didn't meet real opposition. This is often a sign that institutions are present, pushing price without friction. Pro tip: use this principle to confirm breakouts or trend continuations when price closes strong and volume is expanding. Principle number 3: body size reflects sentiment and momentum. A wide body indicates strong market sentiment. Buyers or sellers dominated that session. A narrow body means indecision or preparation. Often it's smart money watching, waiting, or accumulating. Critical combination: a narrow body with high volume is suspicious. Why didn't price move far? 2 possibilities. Absorption: big players are selling into buyers or vice versa. Trap: institutions are preparing to spring a reversal. Read volume here like a lie detector. It shows whether the price move was honest. Principle number 4: candle meaning changes based on chart context. A candle isn't meaningful by itself. Its true interpretation depends on where it appears. At the start of a trend, could be an entry signal. In the middle of a run, might be continuation or exhaustion. Near support resistance, look out. It could be a rejection or breakout trap. Inside consolidation, likely noise. Wait for structure break. Volume confirms context. For instance, a bearish engulfing candle near resistance with rising volume equals high probability reversal. Same candle in the middle of a trend with low volume equals fake out. Principle number 5: volume must validate the candle story. This might be the most important principle. Always ask, is the volume confirming what the candle is showing? Bullish candle with strong volume? Bearish candle with weak volume? Could be a trap. Reversal candle at key level plus high volume? Enter with confidence. When candle and volume are aligned, the trade is reliable. When they disagree, step aside or wait for clarity. Principle number 6: zoom time frames to decode the full picture. Sometimes a candle or volume spike doesn't make sense on the time frame you're trading. That's your cue to zoom out or in. Zoom up to the higher time frame for macro confirmation. structure, supply zones, institutional footprints. Zoom down to the lower time frame for microstructure, liquidity grabs, fake-outs, execution precision. For prop firm trading, this multi-time frame awareness is non-negotiable. You're not just reading one candle, you're reading it inside a storyline that spans across time. Practical volume candle scenarios. Let's apply these principles. Scenario 1, trap reversal at resistance. You spot a bearish pin bar at a daily resistance zone. Volume is extremely high. On lower time frames, you see a failed breakout and then a sharp reversal. Analysis, long wick equals rejection. High volume equals real intent. Location equals key level. Conclusion, smart money dumped into breakout buyers. It's a trap. Go short. Scenario 2, clean breakout with conviction. Price builds a tight flag, then bang, a bullish candle with no wick, wide body, strong close, and volume is double the average. Analysis, candle equals momentum breakout. Volume equals buyers are serious. Context equals continuation from bullish structure. Conclusion, that's your prop level entry. Final takeaways for prop firm traders. These 6 principles help you decode intent, not just price. In prop trading, you're rewarded for waiting for the confluence of clues, not guessing off one signal. Use volume 2. Validate every candle you act on. Spot traps before they trap you. Enter with confidence when smart money steps in. In the next chapter, we'll zoom in on how to build trading setups using these principles, specifically for prop firm challenges like FTMO, My Forex Funds, and Funded Next. Chapter 4, Prop Firm Trading Setup. You've got the knowledge. Now let's build the system. If you want to pass a prop firm challenge or consistently pull profits from funded accounts, you need more than theory. You need a repeatable system, one that helps you read smart money, time high probability trades, and avoid random reactive entries. This is where we bridge volume candlestick principles with prop firm execution, the core prop firm trading framework. Funded traders don't throw darts at charts. They work with a framework, one that answers 3 questions before every trade. Where is the smart money likely to engage? What is price doing at that location? Is volume validating or rejecting the move? Let's unpack the tools that answer those questions. Step 1, define the market structure top down. Start by reading the market on the higher time frames, daily and 4H. Why? That's where institutional levels lie. Supply zones, trend lines, and order blocks. Your goals in this step: identify market bias, bullish, bearish, or ranging. Mark key levels, previous highs, lows, fair value gaps, support, resistance. Detect liquidity zones. Where is retail money likely to get trapped? This is your battlefield layout. Without it, you're flying blind. Step 2, zoom into execution time frame, 15 minutes to 1 hour. Once you know your bias and structure, zoom into your execution time frame, usually 15-minute or 1-hour charts for intraday setups. You're now hunting for volume candle signals at key levels, liquidity grabs, false breakouts with volume spikes, volume divergence, price breaking out but volume fading, no-go. Engulfing candles or pin bars at institutional levels, only if volume confirms. Pro tip, when you're on a funded account, every loss counts. Avoid entries that don't have at least 3 points of confluence: structure, candle pattern, and volume validation. Step 3, entry trigger plus confirmation. Here's what your actual entry should look like. Candle type, wide body candle, engulfing or rejection wick. Volume clue, above average volume on the entry candle. Price location, inside or just after a liquidity zone, sweep or break and retest. Example entry. Price sweeps a support zone, forms a bullish engulfing candle. High volume confirms demand. Enter long. SL, just below the sweep. TP, next significant resistance or 2R minimum. Pro level filter, use VWAP as confirmation. If your trade aligns with VWAP bias, price reclaiming above VWAP after a liquidity sweep, odds increase drastically. Step 4. Risk management for funded accounts. Prop firms don't reward profits. They reward risk control and consistency. Your setup should include fixed percent risk per trade, e.g. 0.5% to 1% max. Daily loss cap, e.g. stop trading at 3% down. Time filters, avoid low volume periods like lunch hours or after news spikes. Only 2 to 3 trades per day. Quality over quantity. Volume and candle analysis gives you accuracy, but risk management gives you survivability. Without both, funded accounts become short-lived. Example setup. Walkthrough EUR/USD reversal. Let's apply the framework. HTF bias 4H, EUR/USD forming higher lows. Bullish structure. Key level. Price approaches 1.0700, a major prior demand zone. Execution TF, 15 minutes. Fake out candle sweeps below 1.0700, followed by bullish pin bar with long lower wick. Volume spikes double the 20-bar average. VWAP, price reclaims above VWAP. Entry, long at 1.0712. SL, 1.0692. TP, 1.0750. TP2, 1.0780. This is a textbook smart money reversal setup, validated by wick structure, volume confirmation, and VWAP alignment. Bonus setup, continuation after breakout. Another high probability trade, catching the retest after a clean breakout. Steps HTF shows resistance at 1.1150. Price breaks out on a wide body bullish candle. Volume surges. On pullback to 1.1150, volume contracts. Re-entry candle. No wick, closes strong. Volume slightly rising. Conclusion. Buyers still in control. Enter long on breakout retest. Checklist before any prop firm entry. Here's your surgical strike checklist. Higher time frame bias. Key level from HTF or VWAP. Volume confirms the move, not divergence. Candle shows intent, engulfing, wick rejection, or no wick body. SL and TP clearly defined with 2R minimum. News filter checked, never skip this. Prop firms don't fund potential, they fund process. Final thoughts for prop traders. This is the difference between a regular trader and a funded prop trader. Regular traders ask, can I take this trade? Prop traders ask, should I take this trade and why? Volume candlestick logic combined with structure and confirmation gives you that why. In the next section, Chapter 5, Conclusion and Key Takeaways. You've just completed one of the most advanced and practical deep dives into volume candlestick analysis, and you're now armed with the tools, principles, and mindset of a prop firm trader. This isn't just education, it's edge. What you've learned. Candlesticks are not just shapes, they're psychological imprints of buyer and seller behavior. Volume is the market's lie detector. It shows you who's truly in control. Combining the two gives you real confirmation, not guesses. You've mastered 6 core volume candle principles, built out a prop firm-ready trading setup, and walked through real pattern-based case studies. Most importantly, you now understand when not to trade, which is where 90% of traders fail. How to level up from here. Review this content regularly. Repetition will sharpen your intuition. Start building a trading journal using these principles. Screenshot charts, mark your entries, record volume behavior. Trade less, but with more certainty and clarity. Stay process-driven. Funded success equals rules plus patience. If this masterclass brought you clarity, saved you from bad trades, or gave you that aha moment, don't leave without hitting that like button, subscribing, and turning on notifications. We've got much more coming for prop traders who want to scale. Thanks for watching.